What's up, everybody? My name is Kyle DePepe. Welcome back, or welcome to my personal finance channel. I do have another car content channel, but obviously you are here for the finance related talk. More specifically, today we're going to be talking about GameStop, why it was up well over, I think 75%. It closed the day up over 50%, and I guess this is why. Alright, so first and foremost, if this is the kind of content you enjoy and you're enjoying these videos, please give the video a thumbs up, subscribe to the channel, it would really help me out. But the topic of choice for today is a GameStop, and yes, it went up over, I think, $30 to a high of 76 or something like that when it opened in the $40 range. So this is a pretty crazy move for one day. And this actually came after a well-known short seller came out saying that the stock should go back down to $20. So if you haven't been following GameStop, which I haven't really been following until I heard about Andrew Left, which is the short seller from Citron Research, he came out and basically said this thing should not be at $40+, it should be trading around 20, I'm short the stock, and gave a whole reason why, and that happened yesterday. Aston, can you stop chewing on it for just a little bit? Thanks, bud. So this, I guess, got the attention of a lot of Robinhood traders, and people refer to them as Robinhood traders because if you are not familiar with a popular Reddit thread called Wall Street Bets, people are always posting their Robinhood accounts, their YOLO call plays, buying these stocks that are either losing money or going bankrupt, like Hertz, for example, if you remember that. And they're looking for these YOLO plays. Basically, they're investing money in either the stock itself or the out-of-the-money calls to leverage and try to make these 20 baggers, I think is what they call them, when they make 2,000%, something crazy like that, right? So it's pretty interesting stuff, but I'm gonna get down to three, I guess, main reasons that can sort of contribute to these crazy run-ups and why they might happen. So the first one is obviously classic short squeeze. So this is probably the easiest and I guess most looked at sort of explanation as to why a stock might run up so quickly in a one-day period, and that is a short squeeze. So if you go to Yahoo Finance, an easy way to do this is type in the ticker symbol GME. Then you go over to statistics. There's tabs at the top, statistics, and you can scroll down and you'll see a tab, or I guess a little area that says share statistics. And if we look at the share statistics, you can see that the average volume is 15 million. The shares outstanding are 69 million. The float is 47 million. So keep note of this float number. The float is 47 million. So the float is effectively the total number of shares that are sort of readily available to buy and sell on the open market. So think about it as sort of liquid shares or shares that aren't held closely to the company. So let's do an example. If you had a company that was IPOing, right? Let's say I had a company and I wanted to IPO and I'm going to issue 100 million shares. Well, me being the owner of the company, I want to maintain control. So I'm going to keep 51 million shares myself. That way I have owned 51% of the company, right? 100 million shares, I have 51 million. That's 51% of the company. Thank you, Aston, for walking in front. So if I issue 100 million shares, I keep 51 million, I keep 51% of the total shares outstanding. But that means the float would then be 49 million, right? That's what I sell on the open market. That's what is readily tradable by everybody else. Now, if you look at my shares, they might be locked up. I might not be able to sell for 3 months, 6 months, whatever it is. I might also, let's say I hold 61 million shares, 10 million of which I use for employee stock options. So I go to hire new employees. I then lock up the ability to buy those extra 10 million shares in stock options. Then, there's 61 million shares locked up. That means there's only 39 million shares of float, right? So that's sort of what's available to the public for general trading, buying, and selling purposes. So now if you keep looking at this tab, this column, I guess, if you will, in Yahoo Finance, shares short 71.2 million. So let's just pause there for a second. The float is 47 million. However, it says shares short are 71.2 million. There's more shares short than there are available, right? So the actual float of the company is less than the total number of shares that people have borrowed to short. So what happens then? Well, that means there's a scarcity of the number of shares that are available to buy. So when you sell short a company or you short stock, you have to borrow that stock from somewhere and then sell it at that market price. So what happens is all of these Robinhood traders, right, or even myself, if I go to Fidelity and I buy stock, right, Fidelity holds that stock for me. It's not like I own it personally. So all of these shares can then be lent out to these short sellers. So what happens? Well, these short sellers borrow they borrow that stock and they're selling it short to somebody else who wants to buy it, right? So another buyer in the market buys that stock from the person borrowing it short. The problem is that typically you need a margin account and there's generally margin requirements. So you have to have a certain amount of assets in your account. And if the stock starts rising, well, what can happen is the brokerage, Fidelity, Robinhood, they can force you to buy that stock back, right? So typically when you buy a stock, you would sell it at some point, hopefully higher. But when you short a stock, you have to then buy that stock back to close out the position, right? If you open the position by shorting or selling the stock to somebody, then you have to buy it back in order to give it back to whoever you borrowed it from. So what's happening is in the short squeeze, there's more people short the stock than the total float. So as the stock starts going up, these shorts have to start scrambling to buy it at higher and higher prices because they're getting flushed out through, basically their brokers are forcing them to buy the stock back because they're hitting their margin requirements, right? They're losing money as the stock goes up because they're short. So this huge percentage, if you go down short percent of float, 260%. So all of these people short the stock have to then start buying it. So now they're buying at higher and higher prices, which causes more and more people to hit their margin limits, having to then buy it back. So all of these shorts now become buyers. So not only do you have the people buying the stock, but you have all these people with even more shares than there are available in the market start buying the stock because they have to close out their short position because the stock is squeezing, hence a short squeeze. So that's one reason why that stock is just getting parabolic to the upside. Now, another type of squeeze is called the gamma squeeze. And this is in reference to options trading. So with options, there's a bunch of things called the Greeks. Basically, it's different ways of understanding how that options price changes based on a change in the underlying, right? So the way options work are an options contract for stocks in this case, they're a derivative of the stock price, right? So you have, GameStop trading at $40 a share the other day. Well, any options price is a derivative of GameStop equity. So when you start looking at the Greek letters for an options contract, you have like theta, gamma, delta, and basically what these represent are different ways that the derivative or the options price can move when the stock moves 1 point up or down. All right, so the gamma squeeze is a very similar thing. So when you start looking at the Greeks, gamma is basically like acceleration and delta is the speed, if you want to think about it in terms of options prices. I apologize for my dog who is in the way, but either way. So if you look at a $10 stock, if the delta is 0.5 and the gamma is 0.1, what that means is for every 1 point move in the stock or the underlying, gamma, the 0.1, is saying that the delta will move 0.1 for every 1 point move, and the delta being 0.5 is saying that for every 1 point move, the option price will move 0.5. If that makes sense. Either way, let's not get into that. The point here is when all of these people are buying out of the money calls on GameStop, what happens is the person who's taking the other side of the trade, the person who's selling that call option, basically wants to be market neutral. So if you sell a call option, it means that you are either selling a naked call option or you own 100 shares of the underlying stock and therefore can sell it to somebody at that strike price. So when these people do these YOLO out of the money call option plays on a stock like GameStop that is losing money and probably shouldn't be trading up here anyways, what's happening is that when they buy a call option, the market maker, or whoever's potentially selling it, but most likely a market maker, they're going to try to remain market neutral, meaning they want to collect that premium, but then they want to be market neutral. So what they'll do in order to hedge that, say the stock starts rising, or maybe just when they sell that position, they basically will go out and buy 100 shares of the stock. So now you have people buying the stock, you have shorts that are getting squeezed, being forced to buy the stock, and you have people that are selling the call options to these people buying the YOLO call options that are buying the stock in order to hedge or getting gamma squeezed, they want to hedge and remain market neutral on selling that out of the money call option. So now you have 3 different people buying the stock where only one of them was intending to buy it or be long, right? So that's 2 different types of squeezes and ways where people can sort of either buy or be forced to buy the stock, therefore perpetuating this crazy, exaggerated up move in a very quick and short period of time. Now, the third and final thing I'm going to touch on in this video is Wall Street bets. The old pump and dump, baby, that's what I'm talking about. So this is basically where people get on and they start pumping a stock and say, oh, I'm buying these out of the money call options, I'm buying the stock, I got in here, keep buying, don't sell, hold it, whatever, you know, and they're loading the boat thinking this thing's going to the moon. Meanwhile, you have people buying on days like today at $60, $70, and Monday it opens at 40 and they're bag holding and they've lost 50% of their money. So just be very careful if you're buying the stock in any of these things, buying it up when it's up 70% in one day on no news other than a short seller coming out and then people on Wall Street Bets and Robinhood basically saying, I don't like this guy, what does he know? This stock shouldn't be at 20, let's keep pumping it. So I would just say be very careful, be mindful. If you want to short it, I wouldn't. If you want to short the stock instead, I would say buy puts, although they can get very expensive because the implied volatility of the stock goes way up when these stocks do these asymmetric moves. So it's definitely an iffy game to start playing. Now, I did buy some puts, so kind of a YOLO put play. I bought the 58 strike, I think February 19th, 18th puts. But my break even is I think in like the mid, I think like $44, $43, somewhere in that ballpark. So not great, but I mean, I think there's no reason for this move, right? It's a short squeeze, it's a gamma squeeze, it's Wall Street Bets, YOLO, pump and dump kind of thing. Like, it makes no sense in my mind, but these are the 3 main reasons why a stock like this can squeeze or have an asymmetric up move. I hope this makes sense. I hope you're more informed. There wasn't really any crazy, like there was no buyout news. There's no insider buying. If anything, insiders are selling because of these crazy prices. They've never seen this. And I think the stock is up over 1,000% in the last year period. So yeah, they're losing money. They have negative EPS. I don't know. The valuations right now, though, in this market don't make any sense. So what do I know? This stock could go to $500 on Monday and everybody would be like, yeah, it's going higher. So this market's crazy. The Fed's pumping money out. The stimulus checks have come out. People are just buying into whatever they can because it just seems like the market only wants to go up. So be careful, but those are the 3 main reasons why and how a stock can have a move like this in a one-day period in such a short amount of time. So be careful out there, but definitely know what you're getting into. Know your risk, know your downside risk or your unlimited upside risk if you're trying to short a stock. And just be careful because you might be caught bag holding if you're trying to buy at these prices. But either way, that's going to be it for this video. If you enjoyed it, please give it a thumbs up. Subscribe to the channel. Until next time, thanks for watching.